Let us start with reading 40, which is working capital management. Here we'll study various sources of liquidity and the factors that affect the company's liquidity. We'll compare the liquidity measures with peer companies, evaluate a company's effectiveness and compare it with peers. Then we'll look at the tools which are used to manage daily net cash position. Then we'll look at the comparable yields and compare portfolio returns against a benchmark and evaluate short-term investment policy guidelines. Then we'll look at the accounts receivable, inventory management and accounts payable functions and their performance against the historical figures and also comparison with the peers. And finally, we'll look into the choices for short-term funding and try to recommend a financing method for short-term. So let us start with the definition of working capital management. Working capital management involves how effectively a company is able to manage its current assets, short-term assets and short-term liabilities. The better is the matching between the short-term assets and short-term liabilities, the better is the working capital management. So the objective is that firm is able to continue its operations and it has sufficient ability to satisfy both short-term debt and upcoming operating expenses. In working capital management, four most important areas to manage are inventories, account receivables, account payables, and cash. The liquidity management refers to the ability of the company to meet short-term obligations. That is, whether the company has sufficient cash to meet its obligation in short term or the assets which can be easily converted into cash. Now let us look at what are the sources of this liquidity. Firstly, they are primary sources which are used in normal day-to-day operations. For example, the cash or cash equivalents such as treasury bills, etc. The collection from our deliveries, the investment income on short term, trade credit which we receive sometimes in lieu of cash on our sales. Then there is bank's line of credit and short-term investment portfolios. So these are the primary sources which are used in day-to-day operations for liquidity. The secondary sources are the exceptional ones that may change significantly the firm. For example, if there's a trouble in the company, it is not able to pay its debt obligations. There is negotiation of debt agreements. Sometimes the company is forced to liquidate its short-term or long-term assets. And finally, if there is no other option available, then filing of bankruptcy. Let us move to the next slide. The factors influencing liquidity. So there are two kinds of factors, positive and negative. First, we'll look at the drags on liquidity that delay the receipts and create pressure due to lack of funds on liquidity. First is uncollected receivables. It means we have already sold the goods, the accounts are receivable, but we are not able to collect them. So that puts a pressure on the liquidity condition. Second is obsolete inventory, which we have not been able to sell. So again, that also puts pressure on the liquidity since we have already invested on raw material. And the third is tight short-term credit due to economic conditions, where we are not getting credit for sufficient time. So that puts a pressure on liquidity. Let us look at the positive factors or pulls on liquidity, which improves that speed of cash outflows to the company. The first one is making early payment. Here we look at the factors influencing liquidity. There are two kinds of factors. One is drag on liquidity, another is pull. Let us look at the drag, which create pressure due to lack of funds. The first is uncollected receivables. This indicates we have already sold the goods and they are account receivable, but we are not able to collect them on time. So it is putting pressure on liquidity. The second is obsolete inventory, where we have already invested on raw material, but we are not able to sell it. So again, it is putting pressure on our liquidity condition. And finally, the tight short-term credit due to economic conditions, that we have not been able to receive sufficient time. The pulls on liquidity are the factors that speed up cash outflows. For example, if we have to make early payments or the credit limits are eased for our customers. So these factors come under pull on the liquidity. Let us move to the next slide. These are few basic ratios that will indicate the liquidity condition in the company. It's basically the ability to repay short-term liabilities from its short-term assets. The first one is current ratio, which includes all the current assets and all the current liabilities. Current assets will include cash, short-term securities, accounts receivable, and the inventory. So if our current assets are much higher than current liabilities, that means our liquidity condition is very good. We'll be able to easily repay our short-term obligations. But since current assets include inventory as well, the company may not be able to convert its inventory into cash immediately, whereas liabilities may require cash. So we need some other parameter which make a provision for this. So we have quick ratio. Here instead of current assets, we have cash, short-term marketable securities and receivables, but not the inventory. So these three current assets are relatively easier to be converted to cash to fulfill our current liabilities. Inventory is difficult, so we have removed that from the numerator. So quick ratio will be more conservative to depict the picture of liquidity. And the most conservative is cash ratio, where we are just looking at cash and short-term marketable securities, which can be easily converted into cash immediately. So cash plus short-term securities divided by current liability. If this ratio is good, we can be very sure that liquidity condition of the firm are good. Let us look at some other ratios. These ratios focus on three most important factors in liquidity: receivables, inventory, and payables. So firstly, the receivable turnover ratio is credit sales divided by average receivables. For example, for a company, suppose the credit sales in 1 year were $10 million and average receivables are at any point in time in the year on an average $1 million. So at any point $1 million is to be received on our sales. It indicates that receivable turnover ratio. It indicates that the receivable turnover ratio is 10, or we are able to turn over the receivables 10 times in a year. Let us look at the inventory turnover ratio. It is the ratio of cost of goods sold and average inventory. Again, if we take the same example, if in the whole year the company has sold say $10 million worth of goods, this is in terms of cost of goods, while on an average the size of inventory throughout the year is say $2 million. That means inventory turnover ratio is 5, or we are able to turn over our inventory 5 times in that year or whatever is the period. Finally, the payables turnover ratio, which is ratio of the purchases made in that period divided by average trade payables. So for example, in the whole year, suppose we have made purchases of $5 million, and at any moment on an average, we have to pay $1 million to our suppliers. So that is payable turnover ratio is 5. 5 times in that period, we are able to turn over the payables. So a basic observation of these ratios says that higher the receivable turnover, better is for the liquidity. Higher is the inventory turnover, better for the company. And lower is the payable turnover. This should be lower. It is better for the company's liquidity. Let us look at these ratios. Let us look at the same ratios in reciprocal. Like the first one, the number of days receivables is 365 divided by receivable turnover. In this case, the time period is say 1 year. So if we are able to turn over the receivables 5 times in a year, so number of days will be 365 by 5, which is 73. That means on an average we take 73 days to turn over the receivables. Similarly, number of days of inventory, it is 365 divided by inventory turnover. Like the earlier case, if we are able to turn over the inventory say 10 times in a year, so it is 360 36.5 days. So we take 360.3. If we take an example, if in a year we are able to turn over our inventory say 10 times, that means the number of days of inventory is 36.5. These many days are required to turn over the inventory once. Similarly, for the payables, it is again the reciprocal 365 divided by payables turnover. So for example, if we are able to turn over the payables 5 times in a year, so we need 73 days for payables. Let us move to the next slide. How do we measure the effectiveness of working capital management? The first parameter is operating cycle, that is days of inventory plus days of receivables. So this represents the number of days which are needed for conversion of the final goods into cash. For example, days of inventory are say 35 and days of receivables are 25. That indicates that it takes 35 days on an average for the goods to reach to the customer, and 25 days are required for this to convert it into cash. So total it takes 60 days for the goods for conversion into cash. So this is our operating cycle. The another parameter is cash conversion cycle. It is nothing but the operating cycle minus days of payables, because these are the number of days which we are getting from our suppliers. We do not need to pay the cash to the suppliers immediately, since they are also supplying on credit, so we get a few days. If we take the same example, if the days of inventory are 35, days of receivables are 25, and days of payables are say 15, so actually the cash conversion cycle will be 45 days. So this is the time which is taken for conversion of cash from product to final outcome. This cash conversion cycle is also called net operating cycle, since we are considering payables too in this case. Let us move to the next slide. Managing net daily cash. This is one of the important challenges which a company faces, because if sufficient cash is not kept with the company, we will not be able to meet our obligations in short term. But at the same time, if we keep too much cash with us, we will lose the interest which we could have got if we had invested in some securities. So the excess cash has to be invested in short-term securities, and sufficient cash has to be kept to meet short-term obligations. The short-term securities could be treasury bills, they could be federal agency securities or bank certificate of deposit, same as fixed deposit of short-term, banks acceptances, time deposits or fixed deposits, the repurchase agreements with institutions or banks, the commercial paper of companies, the money market instruments, and adjustable rate preferred stock. So these are the short-term securities in which excess cash can be put so that we keep earning some interest, and if required, they can be easily converted into cash. Now let us look at the computation of yields. So how do we decide what is the amount we are earning on our short-term securities? So based on the securities, there are multiple ways of representing them. For the treasury bills, discount yield is used. The formula is simple: face value minus price divided by face value. For example, if say 6-month treasury security has a face value of $100 and it is priced at say $98, which is the price, and this is the face value or par value So the discount yield will be 100 minus 98 divided by 100. So this will be 2%. So if we want to convert this into bank discount yield, which is annual, so we need to multiply it with 360 by days. For example, in the previous case, this security was of 180 days. So we will have this 2% into 360 divided by 180, which is equal to 4%. So this is bank discount yield, which is annual. While in the previous case, discount yield is for the remaining time. Now the convention in the money market is different. The difference is we are counting the ratio with price in the denominator instead of the face value. If we assume that it was a money market instrument instead of treasury bill, so our calculation will become 100 minus 98 divided by 98 into 360 divided by 180. So this will be 4.08%. This will be slightly higher than the bank discount yield. Now let us move to the next topic, which is cash management, investment portfolio statement. Now let us move to the next slide, which talks about cash management, investment policy statement. So it is always advisable to have the investment policy statement in written, where the purpose and objective is specified. In the strategy which are to be followed for cash management are given in detail, and what are the type of securities which are allowed for cash management in short term. Who are the individuals who are responsible for the portfolio, and what are the possible corrective steps based on the previous experiences, and what are the limitations in our investment policy. So all these things need to be clearly documented. Let us look at the next slide. Now, how to assess the performance of the company in terms of accounts receivable. We have already looked at two important parameters, which are receivable turnover and the reciprocal number of days of receivables. The another instrument used is aging schedule. In this, we will put various accounts receivable in an year and their duration, and we categorize them into a few categories. For example, in this case, we have put 4 categories where days outstanding were less than 31 days, 31 to 60, 61 to 90, and above 90 days. So this is the case where accounts receivable outstanding is very high, and this where we are able to receive our receivables very quickly. For example, in this case, only 20 were left for more than 90 days and 100 were received within 31 days. And in March, the ratio was different. And in May, 55 cases where the days outstanding were more than 90 days. So in short, this will give us some picture that in which months the days of receivables outstanding were more, in which months they were less, and we can try to improve them if we find any inefficiency in terms of receivables. Since these numbers are absolute, they are not reflecting the right picture, so it is better to calculate them as a percentage of total outstanding receivable. That will give us a clearer analysis. Let us have a look on that, which is called weighted average collection period. So here, these weights are nothing but the percentages. This instrument is called weighted average collection period. In this, instead of absolute numbers, we are taking percentages of total receivables. That was helping us to calculate the weighted average collection period. So these percentages are used as weight. This average collection day is multiplied with the weight, and finally we sum them up and we get 38.8 in this case as weighted average collection period, which says on an average the number of outstanding days for receivables were 38.8. So clearly this is giving us a better picture. So this was about the receivables. Let us look at the inventory now. How to manage and assess the performance of company's inventory. So the company has a challenge. It has to manage a trade-off between the two extreme cases. One, if the inventory is low, then there will be reordering cost. But if inventory is too high, then it puts pressure on the liquidity condition, since the investment in raw material is not being able to convert it into cash. So the challenge is to identify the optimum level of inventory, which allows for both in uninterrupted production, at the same time reduces the investment in raw material and minimize reordering cost. So overall cash flow is increased. One solution is just-in-time inventory, where our prediction models are so efficient that we are able to produce only that amount which we are able to sell immediately. So though it is difficult to achieve, the idea is very useful. And finally, we have the concept of economic order quantity. This is the quantity which is optimal in order to minimize the variable cost so that we are not producing extra and we are able to hold sufficient inventory so that we can cater to expected orders in time. Now let us move to the third important aspect, which is account payable. As we've already discussed, the parameter used is payable turnover, which is cost of goods sold divided by accounts payable, or the number of days of payables, which is nothing but the opposite of it, number of days in the period divided by payables turnover. We have seen 365 since we were considering annually. There is one other way we can put this formula, which is accounts payable divided by average days purchase. This will also provide us the number of days of payables. Here too, we need to make a balance between two countering forces. One, if we pay too early, it is costly, we are losing interest. Unless the case where company has been offered a discount for paying early. And the another force is if we postpone the payment beyond the end of credit period given to us, then it is a case of stretching accounts payable or leaning on the trade. This might have a negative impact on our future orders. So we need to make a critical balance between these two. Now let us move to the next slide. What are the choices of short-term funding? So if we require cash in short term, what are the instruments available? Firstly, we'll look at the bank sources. One of the most common is unsecured loan, when we take debt from the bank, but we are not keeping any assets as collateral to the bank. The second is line of credit. This is typically issued by the bank. They are charging a fee for issuing a line of credit. It is basically a promise from the bank that payment will be made by the bank on behalf of the customer. There are certain conditions which need to be met. They are generally used to guarantee a payment to some client or supplier. So there are two kinds of line of credit. One is committed and second is uncommitted. Committed lines of credit are stronger because they ensure the formal commitment of the bank. The third bank source is revolving credit agreement. When a firm has a long-term relationship with the bank, a formal legal commitment is given by the bank to extend the credit up to some maximum limit over a stated period of time. Similarly, there is banker's acceptance. These are short-term promissory trade notes. So they are issued at a discount and the promise is made to pay the face value of the banker's acceptance. And finally, there is factoring, where the firm tries to get receivables before the credit time by offering a discount to the customers. So they pay early and get a discount, and the company gets receivables early so that they can fund their short-term liabilities. Now let us look at the non-bank sources. The commercial paper is issued by the firm itself, and if it is a large firm with good credit worthiness in the market, their commercial paper will be accepted. It is short term and it is unsecured. There is no collateral associated with it. But this is generally cheaper than short-term business loan from a commercial bank. To ensure that commercial paper is paid, dealers often require line of credit. NBFCs, non-bank finance companies, also issue commercial paper. Now there are certain parameters which are important to create the best mix for short-term financing. The first is cost of financing method. For every firm, the cost of financing will be different for different instruments. So it should go for where the cost is minimum. Then availability of funds which are already there with the company. Timing, when a liability is to be met. The financing should be at the same time so that we are avoiding any extra expenses. Then the flexibility of usage. For example, if there is some amount of cash with the company, it provides flexibility in terms of payments. And finally, the degree to which the assets are encumbered by the company. So these are the factors which determine the appropriate mix for short-term financing. So this has brought us to the end of the topic.